Today, we're going to talk about life insurance. Another great topic. There's a couple different types of life insurance. All right, we're going to go over these. You got term, you got whole life, and you got universal life. What is the upside to life insurance? Why buy it? What's the point? Well, as I explained in previous videos, it protects your loved ones from financial hardship. And I know you may not know this, but all of us are going to die one day. All of us. Well, maybe not me, but definitely you. All right? You're going to die. Could be tomorrow, could be 10 years from now, could be 30 years from now, whatever. You're going to die. Life insurance protects your family from financial hardships were you to die. Another benefit is low cost versus the amount of protection you get. Let's say I get a term policy for $1 million of coverage. It may only cost me $100 a month, $150 a month. That ain't that much. It's cheaper the younger and the healthier that you are. And if you think about it, it kind of makes sense. So the life insurance companies are in the business of making money. Okay, so they want a profit. They know everybody's going to die. They actually know roughly what age you're going to die at based on what you do. If you're a smoker, they already have a bunch of actuarial tables that tell them when you're most likely to die. So in their minds, if you get a life insurance policy when you're really young, let's say you get a 30-year term policy, well, to them, if you're super healthy and young, you're probably not going to die. So it's not as expensive. They're not going to charge you as much because the risk to the insurance company is lower. But if you're 60 years old and you smoke and you're fat and you never worked out a day in your life and you want to get a 30-year term policy, that insurance company is going to charge out the butt because you are much more likely to die. And if you die, they're going to have to pay your family the death benefit. Does that make sense? I hope so. And last but not least, your financial plan sucks without life insurance. It sucks. What's the downside of life insurance? It costs money. Boo-hoo. You got to pay money to protect your family. I know. You may have to forego a pizza or two every month so you can actually afford the premium to protect your family in case you die. All right, term life insurance. What is term life insurance? Basically, it's an insurance that protects you for a fixed period of time. All right. You pay a level premium, which is the cost of insurance. You pay a level premium for the duration of the policy. And as long as you pay that premium, the policy stays in effect. If during the course of your policy you die, the insurance company will pay your family the death benefit. So if I get a $500,000 policy and then I die tomorrow, whoever my beneficiaries are will receive $500,000. And I will pay the same amount every single month. All right, so there's different time periods you can get these policies for. You can renew it annually, which means every year you pay a certain premium, and then the next year your premium goes up a little bit. And like I said, I explained that earlier, that's because the older you get, the more likely you are to die. So the life insurance company has to charge you more because they're taking on that risk of you dying and having to pay the death benefit. So you can do annual renewable, or you can do a fixed term, 10, 15, 20, 30 years, whatever you want to do. There's no cash value in term life insurance policies. I'll go into that in a little bit, but basically you're literally just paying the premium, you got the protection, and when the term of the policy expires, the protection's gone and you don't get anything back. All right. I recommend you lock in a term life insurance policy when you're young and healthy. And I'm a good example of that. So I'm 30 years old. I'm about to get married and have kids. I need to protect my family for the next 30 years, at least, in my opinion. So, because I'm young and healthy, I'm going to go ahead and purchase a 30-year term policy that's going to protect my family throughout that 30-year term. And the price isn't going to be that expensive because I'm 30 years old and I'm healthy. And last but not least, term life insurance is extremely cheap because it's not lasting your whole life. So it's not going to cost as much. All right, let's compare that to whole life. So term life insurance is for a term, for a fixed period of time. Whole life insurance, as I hope you can glean from the title, lasts you your entire life as long as you pay those delicious premiums. All right. So a standard vanilla whole life policy is going to pay a level, you're going to pay a level premium every single month. Every month you're going to pay what, $200, $300, whatever your policy is. All right. That premium goes to two places. It goes to cover the cost of your insurance, which is what your insurance actually costs. And then part of that premium goes to build your cash value. And that cash value over time defrays the risk. It lowers the risk of the insurance company if you were to die. And we'll have charts later to explain that. All right. So in whole life, you're paying a level premium every month, and you have a level death benefit. So if you pay those premiums to the day you die, you're going to get that death benefit. So if you have a $500,000 policy, as long as you keep paying to the day you die, your family's going to get $500,000. All right, that's how that works. All right. So like I said, this policy, this vanilla policy has cash value, and it accumulates over time. It grows at a fixed interest rate, and it really depends on the contract that the company writes with you. So the contract might say, all right, your cash value is going to grow at 3% a year till the policy to 100 years old. That's when most whole life policies are actually projected to last till. All right. So that cash value is going to grow. So you're getting some kind of return out of that cash value. All right. Now, if you don't want to pay this policy your whole life, you have some options. You have some flexibility. Let's say you got a good amount of cash value and you're tired of paying the premium every month. You're just done. Well, you can actually keep some of the death benefit. And how that works is you take your cash value and you buy a paid up policy. Now, what that means is if you just give the insurance company a fixed amount, they do the math and they say, okay, if you pay this much right now, we will give you a reduced paid up policy in this amount that will stay in effect for the rest of your life. So let's say I have a policy that has $500,000 of protection, right? And I have $200,000 of cash value. And I'm like, okay, I'm sick of paying these premiums. I want to reduce paid up policy. So I say, okay, insurance company, if I cash in, if I buy a reduced paid up policy, how much protection will I get? And they'll be like, all right, well, with $200 of cash value, your death benefit will be $350,000. I'm like, all right, great. So you take that cash value, you buy a reduced paid up policy, you don't have to pay a cent more for the rest of your life, and your family's going to get that death benefit when you die. All right, hopefully that makes sense. You can also just cash out your policy entirely. If you're just done paying it, you can just take out that cash, all of it, cash out the cash value, policy lapses, and you got the money. Pretty simple. All right. You can also take loans against your cash value. And another note is that cash value in the policy grows tax-free. All right. I just wanted to put that note in there. Now, the downside to whole life is that it's expensive. It's 5 to 15 times more than term on average. Depends on the company, depends on you. But generally, you're going to pay way more in premium every single month. And that can really eat into your budget, especially if you're younger. All right, so I did a little illustration for you. Pretty simple. So your premium, what you're paying every month, is on the left. And then that premium goes to two places. It goes to your cash value, the little piggy, and then it goes to the cost of insurance, which is the actual cost of insurance. All right, illustration number 2. So on the x-axis, we have age, and on the y-axis, we have cost of insurance. And basically what this is showing is that when you're young and you start paying your premium, your cost of insurance is actually less than what you're paying. So if I'm paying $200 a month and the cost of insurance is only $100 a month, well, the rest of that money is going to my cash value, okay? And what happens is, over time, that cash value grows and grows and grows. And the insurance company is only responsible for paying, well, let me correct myself. The insurance company is responsible for paying the entire death benefit. But their risk, what they actually have to pay, is the amount in excess of your cash value up to your death benefit. So let's say I have $300,000 of cash value when I'm 80 years old, and my policy has a death benefit of $500,000. Well, when I die, the insurance company is going to pay the death benefit of $500,000, but they're only at risk for $200,000. That's because the cash value is $300,000. So they're only really losing $200,000. Hopefully that makes a little bit of sense. So when you first start paying, your cash value builds over time, and the more it builds up, the less risk the insurance company has. Now, you can write some policies, or you can get a policy where you get the cash value on top of your death benefit. We're not going to go there right now, but basically just think of it as that cash value is reducing the risk for the insurance company. All right, so that covers whole life. All right, universal life. What is this? So this can be a permanent insurance. This can be a permanent policy. What it is it gives you a little bit more flexibility. All right, what does that mean? So it's kind of like whole life where you pay your premium, and part of that premium goes to the cost of insurance, and part of that goes to your cash value. The difference is that unlike whole life, where you pay your premium and you're good and you don't have to worry about it, for universal life, you can actually invest your cash value in different investment vehicles. So for example, let's say this universal life policy allows me to index or track the gains of my cash value based on the S&P 500, all right, which is a stock index. So if the S&P 500 goes up by 10% that year, well, my cash value is going to go up by 10%. The only caveat is that you may have a part of your policy that says you have a participation rate. And what that means is the insurance company might be like, all right, well, if the S&P 500 goes up by 8% a year, we'll credit that to your cash value. But if it goes up more than that, well, we're not going to credit that amount to your cash value. So if the S&P goes up by 10% and my participation rate is 80%, well, I'm only going to get that 8% return. All right. So that's kind of one of the little disadvantages, or one of the things they can add to your policy. So universal life gives you flexibility because you can also defer paying your premiums. So let's say you have a year where you're in trouble financially and you can't afford the premiums. Well, the insurance company will be like, okay, well, you have cash value, so we can use that cash value to help you pay your premium. As long as you have cash value in that policy, you can pay that premium. The only downside is that if you deplete your cash value and you're much older at that point, well, your premium is going to skyrocket because your cost of insurance increases every year you get older. So it can be really risky, especially if your investments or whatever the policy is indexed to doesn't perform as well as you thought it was going to do. And if you run out of cash value and then you can't afford just the cost of insurance, well, your policy's going bye-bye. All right. So this is something that it gives you more flexibility, but you're taking on a lot more risk. With whole life, you pay the premium, you're good. That's all you have to do. With universal life, there's a lot more risk involved. And there's different types of universal life. It's a whole in-depth subject. But this is kind of the basics of how this all works. All right. I recommend you get term, 100%. I have term in myself. I have no whole life, and I'm never going to buy whole life. All right. Number one, term is affordable. It's very cheap compared to whole life and universal life. All right. Very cheap, and it gives you a large death benefit. Yeah, I may not die in my family, or I may not die before that policy lapses or expires. And if I don't, well, then I just paid all this money to protect my family, but I didn't realize any benefits from it. Well, that's kind of the point. The insurance, it's not an investment. It's there just to protect your family. I need to protect my family for a certain period of time. And once I don't need that protection anymore, I don't need the insurance. All right? So think about it this way. What are you protecting your family for? What do you got? Maybe you got a mortgage. Maybe you have to pay for your kids' college. Maybe you have to protect your wife's, income because you're earning a salary every month. All right? But if my mortgage is paid off, I've already sent my kids to college, and I'm protecting my wife's, and I've already retired. What am I protecting? You don't have to protect anything. You're already self-insured. My plan is when, like right now I'm 30, my plan is when I'm 60, I should have a couple $1,000,000 in investments. All right. So if I were to die at 60, well, my term policy expired. Oh man, but I got a couple $1,000,000 of investments. I don't need to protect anything. I'm self-insured. I have enough money to give to my wife to protect her standard of living for the rest of her life because I invested it. All right. Also, the death benefit on whole life is actually severely reduced by inflation. All right. So you may think, oh, I got a $500,000 policy, which I didn't add to this, but this example at the bottom is for a $500,000 whole life policy. So let's say I got a whole life policy for $500,000 right now at 30 years old, and I live till I'm 80. All right. So inflation increases every year generally. All right. The actual buying power of the dollar generally decreases every year. So every dollar in the future is worth less than it is now. All right. So if there's an inflation rate of 3% for the next 50 years, that $500,000 death benefit that my family's going to get, it's only worth $114,000. Okay. And like I said, does my wife really need that? Do I need to pay this policy my whole life so I can give my wife $114,000 when I die at age 80? No. Okay. Hopefully that makes sense. If you have any questions about this, you can post a comment and I'll be more than happy to answer it. All right, final note. I actually used to sell whole life policies. I was a financial advisor, all right? And our commissions for whole life were much, much higher than term life, all right? We were encouraged to sell whole life because that's what made the big bucks. And if you didn't sell whole life, you didn't make it. So my company built this huge training, regimen where they taught us how to sell whole life. And that was just to make more money. Whole life isn't always bad for everybody. All right. That's a good caveat to understand. It's not the end of the world if you have a whole life policy. But is it a great deal? I don't think it is. And if you look at how much these agents are compensated, the commissions are way higher for whole life. What does that tell you? Sounds like it's a lot more profitable for the insurance company. And when the insurance company profits more, you're probably getting the short end of the stick. All right? Well, thanks for tuning in. Hope you enjoyed this video. If you have any questions, please post a comment. Have a good day.